Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. So really excited about my guest today. It is Monday, the 24th. It's already way into the summer, 2024, but super excited about my guest, Chris Cunningham. He's a managing partner at C2 Ventures. We've talked about a lot of things on the professional side, but also on the personal side as well. You know, we were just before this episode just talking about how all of us are kind of pretty much growing up together, evolving as people, evolving as professionals. So excited to just go deep on all things venture, private equity, infrastructure, all the things that you're working on, Chris. So why don't you just formally introduce yourself and talk us through kind of your early career, your education, and how you got into venture, and then we'll go into the details of how you're building this firm as well.
Awesome. Joel, great to be with you. And yeah, it is definitely summer when it's 100 degrees here on the East Coast over the weekend, but we're in it now. I'll go really high level and then, peel back the onion however you wish. I always like to cover half my life in 3 seconds because you never know where that takes the conversation. But I was born in Finland, my mother's side, Scandinavian, came over when I was 3, grew up in Boston, Massachusetts, and went to school in North Carolina, moved to New York in 99, 2000. So there's kind of 3 points of reference of kind of upbringing and all that. I jumped into the internet, the online kind of boom back in 99, 2000, Music Vision, Bolt.com, Webs.com, were all companies that I had sort of commercial roles, cutting my teeth, selling online advertising and banners back in the day. So a lot of the OGs that helped kind of, build the internet, if you will, even though I know that sounds like an extreme statement, but definitely one of those people, really, really early days. I started my second tech company called AppSavvy in 2007, which pioneered the idea of monetizing Facebook apps. So before smartphones, there were apps on Facebook, and we would do sponsorships and integrations with Fortune 500 brands. Took that company to about 150 people, drove close to $100 million in revenue to the app ecosystem. Made a lot of mistakes along the way, as you can appreciate, being a tech founder, but nonetheless, a lot of great experience. Held 2 commercial roles, both in a location data company and IronSource, which is now the largest publicly, I think they're the largest publicly traded tech company in Israel. All great experiences. Did not have the energy or the idea, quite frankly, for another tech startup. I started doing angel investing and advising under C2V, which was a placeholder name back in 2014 for, tax write-offs and just trying to organize my personal investments. Did 20 investments, had some luck and success, get into the trenches with companies, loved it thoroughly, wanted to institutionalize it, and met up with my partner, Matt, 8 years ago to start seed stage investing alongside with a pre-seed fund. And I know we're going to have some dialogue, but high level now, C2 Ventures is, the name is 10 years in the industry. We've been doing this for 7-8 years together. We're basically investing in what we call dirty, dull, and dangerous industries, enterprise, B2B SaaS. Joel, think about the most boring, mundane, unsexy industries on earth: dental supply software, bathroom cleaning, construction, insurance tech, prop tech, med tech. So Heartland America is where we see a lot of our companies, including the Northeast, because we're in the New York, Connecticut area. 3 funds under management, 150 LPs, 52 portfolio companies, and that's what I'm doing now. So that's just some high level notes on me and background, and excited to chat.
So tell me a little more about, I would say some of those essential service businesses. What's exciting about those is just super cash flow rich businesses, right? And some of them, especially like when it comes to like pest control, recurring subscriptions, right? Because people are always going to need pest control, especially property managers as they're, fixing the properties, properties that, this being in the city, whenever there's construction work, there's a lot of issues with pests. So it's just, ongoing maintenance. I looked at a fund that was focused on roadways. So like, the paint that you put on the different, streets, the pavement, all that kind of stuff was just all stuff that just always needs probably long-term government contracts and
Correct.
renewals as well. So tell me a little bit, if you can unpack those different industries, right?
Yeah.
Can you share some
Well,
trends in terms of the
well,
pros and cons or the benefits of all those?
yeah, no. So I'll answer. I know what you're getting at. I'll answer it this way. As far as the thesis and why we invest here, right? Because
Mhm.
venture, historically has, there's a lot of different kind of focuses out there, generalist and consumer. There was kind of the crypto and NFT and Web3 craze, fintech. There's a lot of different categories. What we really started thinking about years ago was, in a world, in pandemic worlds or inflation, interest rates, kind of when there's sort of headwinds and macro forces that you can't control, and you're investing, what are the industries that are essentially, Joel, recession proof?
Sure.
Bathrooms always will have to be cleaned. Roads will always have to
Mhm.
be paved. Potholes have to be fixed, right? People will
Mhm.
always go to the dentist. Again, this is all with sort of, rationale and moderation, but I think you get the idea. If our job as GPs managing LP monies to make money, right, and make returns, because that's at the end of the day what we're getting paid to do, our job is to de-risk as much as possible. So the way we think about de-risking is pick industries that are essentially never going to go anywhere. They've been around for 50 years, 100 years, 20 years, 30 years, and they're not going anywhere. That's one way to de-risk. I'm going to pick on Web3 or NFT. Maybe not. Who knows if those industries really have to sort of be there. So one is the industry. Two, the size of the market, the TAM, the total addressable market. It's easy to de-risk when you go into an existing pool of revenue, and customers that may just be working on sort of antiquated technology, things that are just not scalable or efficient, spreadsheets, paper. So that's another way. My point is, and then, sorry, the third part is where we're investing. We really like underserved and overlooked founders, as
Mhm.
well as the geographic location. A lot of elitist VCs believe that only the best tech companies can come out of New York or San Francisco. We could not disagree anymore on that point. Of course, I love New
Sure.
York. I lived in New York for 18 years. I'm from
Mhm.
Boston. Of course, there's going to be world-class technology founders coming out of this area, but
Sure.
don't sleep on Michigan or Alabama or Ohio or places in Canada. So just to unpack that in like 5 seconds, our thesis is concentrated around de-risking in ways that match geographic thesis, stage, market, and sort of areas in which the macro world will have nominal or little impact on that respective industry. Does that make sense?
Oh yeah, no, absolutely. I mean, I just know it's a huge untapped market. There's all, so let me ask you this. Are there benefits in terms of the price point that you come in for valuation now in the Midwest? I mean, I've seen kind of the valuations of other countries grow. Like, so, India, you can't even get into some of these hot deals in India now. And like the valuations are very similar to the
Yeah.
US. And then, fast follow I've seen was like Pakistan, Bangladesh, Nigeria. So a lot of those deals, I mean, they're just as oversubscribed as they are here.
Yeah.
So I know probably around 4 to 5 years ago there was lower valuations that you could probably arbitrage. Coming in maybe in the tertiary cities. But is that still the case, or are the valuations at par now to Silicon Valley and New York valuations?
It's a, Joel, it's a great question.
Mhm.
First of all, and I'm proud to say this. When the before the markets kind of went sideways, inflation specifically, kind of this recession we've been in, interest rates have skyrocketed. I think we've been in this for what, Joel, the last 18 to 24 months. It's been roughly just, about 2 years or just under. While things were peaking, a lot of investments were made top of the market. And a lot of VCs are struggling because they overpaid for companies that did not mirror the growth that they were meant to meet, with sound unit economics. We don't have one company in our portfolio that we overpaid for. Mm-hmm. So the point there is, there's a discipline around venture, which is no matter how hot the company is, no matter who's coming in it, who cares if Andreessen or Sequoia is, who cares?
Yeah.
You got to stay disciplined with your own thesis and what makes sense from a portfolio construction, because if you overpay, you get screwed. So one is just sort of a general comment as relates to your the point that you made.
Sure.
Now, specifically for, say, the Midwest, Heartland America, but even New York, there are definitely better price points outside of New York and the Bay Area. There's no way I can't say that, because it's true. However, the discipline of staying in at around seed, which is a good place to be, because when you look at, say, the Instacart IPO, if you read that S1 or do any of the research, Joel, it will show you that while they raised an extraordinary amount of money, hundreds of millions of dollars, or maybe $500 million or whatever the number is, anyone that came in outside of seed made no money. So my point is, getting in really early with a ownership of 3-4% up to 9-10%. Of course, every VC wants double digit for obvious reasons to sort of manage future dilution. You're well positioned. So I think the question is, my point is less about the geographic location. It's more about the discipline of the firm and never overpaying, no matter how much you love the company.
Yeah, no, I totally agree. Well, tell me how you source and screen these deals. What's kind of the way that you can, with this sector, right? Obviously they do have new platforms and new communities to look at these type of sectors, right? They have, they probably have demo days. You probably work closely with, I forgot the big developer that's in Boston that now has a big venture arm, right? I forgot their name. I forgot the name, but there's a lot of prop tech accelerators now, and infrastructure communities. But how do you find these founders? And then,
Sure.
I know some of that is your secret sauce and your networks. And then how do you screen them? What are some of the things that you look for when you're evaluating the founder? And then what are some of the KPIs that really stick out to you, whether it's revenue or, contracts? Maybe you can share some of that insight.
Yeah, no, good question. So the percentages I'm going to give you, Joel, have completely reversed since we started. So you'll figure this out. Mm-hmm. The number one source of deal flow is, and we're really proud of this, is inbound. It's founders finding us. We're pretty active on kind of our, LinkedIn profile and sharing good content, or decent content, depending on who you ask. Sure. Our newsletter with 5,000 subs. We have obviously great portfolio companies where we're mentioned. So founders are finding us through good old fashioned Google and SEO search, and through LinkedIn. And they're doing the research, they're identifying with our thesis, and they're recognizing that we're a good fit. We love that. That is like the best. Now, of course, you're going to see a lot of companies that aren't real, and there's some shitty spammy ones in there. But founders finding us, number one. Two, our LPs, many of them have made the conscious choice that they don't want to make direct investments anymore because it's just too challenging to kind of pick a handful of deals. So they have become an LP in our fund, and therefore when they see deals, they send them our way. Number three, our founders tend to really like us because we roll up our sleeves and get into the trenches with them. We help them with their cap raise intros. We have LPs to plug them in. So our founders refer other founders. So those are kind of our top three. And then from there, it's partners like Cornell Tech, NYU. We just did a deal through ERA that, at a demo day, you mentioned that earlier. I'm an LP in Techstars. So the early kind of pre-seed incubator sort of profile, we see a lot of companies from their launch, Jason Calcanis. And then occasionally we see deals from other VCs. We never rely on other VCs for deal flow, but if a good VC friend sends us something, we look at it in the same lens, Joel, as if we got it from somebody else. Just because from a VC doesn't mean that it's more qualified or less qualified. We feel pretty strongly about that. So kind of 4 or 5 buckets, but when we started, it was completely the reverse, right? And then it's taken many years to kind of develop a reputation and a brand in the industry where you start having people hear about you. Having said all that, we don't see it all. We wish we would. We're going to miss deals. There's always deals that we're just, for whatever reason, we're not going to catch, but we're seeing 30 a week, and hopefully we can continue that sort of pace.
Yeah, no, that's great. And you talked about brand and storytelling and, just kind of being, top of mind. I've seen you create some really great content on LinkedIn, especially the short form content. So, what's your advice to just emerging founders and brands in terms of short form? And it seems like that's been working for you as well. Just kind of having people kind of learn from your thought leadership. I feel like that also attracts founders, especially if you're adding value, right? If you're providing educational content in terms of like what's worked for you, some authentic storytelling. I think that definitely resonates well with trust. And, I think it was, there was a conference, I think a couple days ago called the Iconoclast Conference. And there was a lot of insights around just kind of storytelling, which I think is really important. That's going to really help brands, the newer brands, stand out, and I think a lot of the legacy brands are going to have to lean into more of that. But I don't know if you have any wisdom on just kind of brand development and just if short form content works. If it has been, what's the content that you've noticed has worked to resonate better with brand building?
Yeah, no, I like the question. So first of all, I think it's dependent on every founder and dependent on where he or she is in that journey, because it really is something that I think is not for. First of all, I don't think it's for everyone. I think it has to be something you have to be comfortable with. Clearly, you enjoy this, you like it, and you're good at it, right? It's something that needs to kind of come organically. So start with that. I do think that. Whether it's a medium post or the short form videos that I do, I did a podcast, as you know, Joe, for a while, Superpowers, which I'll probably reboot under kind of a new framework that I've been thinking about. But it is time consuming, and there is preparation, and I'm sure you can attest to this yourself. So I think so. The second comment is, I think for our founder is really just ensuring that pick the right time for when it makes sense to even consider doing any type of kind of branding or whatnot. But now let's suppose you're there. I like the short form video because it's less work than a podcast. You can do it kind of off the whim. I generally do it in the same location. There's 1 or 2 locations I do, so it becomes somewhat of a consistent background, if you will. These are what I think about is trends that I see and then sharing those trends. So it's a pattern recognition piece. I'm not going to share an opinion if I only see it once, but if I see something 3 or 4 times, like a pay to play scenario, okay, let's talk about that. Or, are safes good or bad? Let's talk about that. Or, founders should be really thinking about a 10-year journey, not 5 to 6. I think founders have kind of changed a little bit over the years, unfortunately, as far as their kind of like endurance. So, but there's got to be some sort of pattern recognition. And then I just try to do that in a couple of minutes with a little bit of copy, and it works. And, I enjoy it. So I think the only thing I would add there too for founders is, if you're driving or creating a new or open up sort of a new market, thought leadership is super important. So you're either getting on panels for free, you're either getting mentioned in stories for free, hopefully, or you're doing some kind of thought leadership on LinkedIn and doing it consistently. but I would tell founders not to do it unless they believe that they can try to do it in a consistent way
Mm-hmm.
that doesn't take an enormous amount of time. And finally, that you have a core purpose and agenda or objective, for who you're trying to reach. Obviously, I'm trying to reach respective LPs and founders for the most part. Those are my two kind of markets, and probably other VCs. And there's probably another fourth or fifth, but then those are the main two. So if you're going to do it, make sure that you're doing it in a way that has you have a potential output in regards to the audience you want to reach. But it is a lot of fun if you do get it going.
Sure, yeah, and I think there's a lot of cool AI tools. So, there's a tool that I really like. It's called Opus Pro. And if you take a short form piece of content and upload it into YouTube, you can actually paste the YouTube link into Opus Pro, and then Opus Pro will analyze the entire long form content and chop it up and actually give you captions, which I thought was really cool.
Yep.
So I actually used it last week. But I do think a short form strategy is definitely different than a long form strategy. So I think, if you go deep on short form and you're posting snippets of like maybe the podcast, I think it makes sense. I think 20VC does a really good job doing that. 20VC has the one podcast. I think they do long form, but I do see a lot of cool content. There's just like captivating pieces of content within that podcast that, where the speakers may be sharing something that was meaningful. And they were able to kind of capture that in a split screen, which I thought made sense. But then the long form, it's a long form in a sense. There's YouTube, and then you can use the audio for the podcast as well. But definitely like on mine, I've just been kind of live streaming, and, my goal is to hopefully productionize it a little more to have better content and push it out to all the channels. But, it's just another, line item of production work that you want to do. And I think if you do a really good job, I think it's super fruitful.
I agree. And I do think that's a good comp as far as a show to listen. And listen, so as you know, that's a completely different level of production and time, but I do think LinkedIn is where founders should spend their time. I think Twitter/X is kind of probably impossible to build kind of a meaningful profile today. I think you would have had to, anyone that has a voice there probably did it at least 15 to 20 years ago. But I do think LinkedIn is a very important platform for founders to begin to build their thought leadership.
Yeah, no, I totally agree. I think LinkedIn is just kind of where all the professionals are. And, I think Twitter, what are your thoughts on Twitter? So I think, a lot of fund managers and, there's a lot of LPs now that are pretty active on Twitter. I think it's a different style and a different audience. But I think, capturing the right context and kind of the right packaging of that information definitely helps as well. So,
I think the creator profile is so small on X today, and it's almost like its own echo chamber of VCs talking to other VCs more than anything, which is fine. I just don't think it is what it used to be. That's all.
Yeah. What advice would you have? Tell me about your story of kind of. Can you still hear me?
Yeah, Joe, I lost you just for two seconds.
Yeah, can you hear me now?
Yes.
Okay, cool. So tell me a little more about, just your story of kind of building the firm and how you took it to where it is now, and then maybe some advice that you have for emerging fund managers.
Yeah. So as far as like the journey of building the fund.
Yeah.
Yeah. I mean, look, I think there's a few different ways to start a fund, and I hear today it's probably the hardest sort of point imaginable to build one. But
sure.
And I'm not saying this is right. This is just my own two thoughts. One, I think if you want to get into being sort of a fund or VC or running a fund, you're probably going through a traditional large venture firm as sort of an associate, then sort of venture partner, analyst, and kind of working your way up, right? Until eventually, hopefully you're getting your own deal flow. That's fine, long journey. And then maybe you get some wins and you branch off. Two is the most sort of traditional route. You sell your company for a boatload of money to Google or, Microsoft or whatever.
Sure.
You make hundreds of millions of dollars. Now everyone believes that your founder's success is going to transition to venture. I don't think that's actually the case. I don't think those two things are always go hand in hand. Or you do it sort of the old-fashioned way, which is, you build it kind of brick by brick. And I do think, I don't think C2V would have gotten going without the 20 angel investments that I made. I put a little over $500,000 of my own money to work. I think my wife knows about half of that. I became an LP in a couple funds because I wanted to cut my teeth and understand what it was like to be an LP.
Yeah.
The point is, in order to do this, you need to have some credibility in some respective field where you have a superpower and you're the kind of known within a group of in a community that you're trustworthy in this respective field, and you have some merits as a previous founder or whatnot. Then you need some traction. Then you need a partner. So there's a lot of different components that kind of go into it. I think the most important thing today is the focus in and around thesis. And I think thesis and focus in venture is probably what's needed the most as one potentially thinks about going into venture, but also how they want to, if they're thinking about raising money, be sure you know what that venture firm does and doesn't do, because you'll accelerate your path to healthier conversations if you're a little bit more specific and tailored to who you're reaching out to. But it's definitely a tough game, Joel, to get into, and probably a harder one to sort of to stay the course. But it's a lot of fun, and it's definitely not. I'm one of the few people that have been a tech founder, and VC. I'll tell you right now, the founder journey is much harder.
Sure. No, that makes sense. So one maybe final piece of advice for emerging fund managers, there's a few on here, in terms of kind of building an engaged LP community. What are some ways that they could, build maybe some of those first connections and maybe, cultivate them and get them over the line to believe in investing in you.
Right. So just some advice for founders specifically to,
I would say, fund managers meeting LPs.
Right.
Is it, just to kind of, is it going to conferences? Is it,
as far as us meeting
fund managers? Yeah. So there's a few emerging managers on here. So like, what would you advise? So obviously some people go to conferences, some people are doing dinners, they're going to private events, they're doing thought leadership. So maybe one or two nuggets of advice before we go in terms of what you would advise fund managers. I feel like I thought you were going back to get me show us a poster or something.
No, kids are off school as of Friday. So
same here.
Yeah, so we have a few 11-year-olds that are trolling my home office. I'm generally in Greenwich, Connecticut, which is where our office is, or the city, as you and I talked about a few weeks ago. But today, for podcasts and stuff like that, I need my trusted mic here. Honestly, Joel, there's no magic bullet. It's just really, really friggin' hard. I would say that the number one thing is the long-term relationship building and the networking piece. And once you do crack a worthy and high-profile LP, get an introduction to his or her friend, updating them on a consistent basis so they can see your traction. What I've learned is the best LPs, they want to track you for years. 2 years, 3 years, 4 years, 5 years. So, being at the right events is definitely the right thing, right? You got to be at the right events. You got to be in front of the right people. You got to build relationships and stay with them the course. And you need to show some level of traction as you build. And that may not be through exits, because exits take longer today in our world than it ever has before. But you need to show at least healthy markups in your respective business.
Sure. Well, that was so helpful. Really appreciate it, and I totally agree. I mean, most of the LPs just invest in who they trust and who they like, and obviously, there's been probably referrals from maybe other LPs that have invested in them, and it's a small ecosystem. So, totally agree with everything that you said, and looking forward for me coming out to Rye or you coming out to a city to get some
I'm in the
get some
city,
tasting.
man. I'll find you there. You need to come out to Rye and put your feet in the sand with a cocktail, and I'll do my Houdini recruiting trick on you.
Well,
next
tell
time
me
you
your
call.
local spot, and you told me that all the home there's no availability there, so I'll have to talk to some of the people there and check out the inventory
We'll
because
we'll 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 get you in front of the right people if you ever want to take a look. The door is always open for you, man, to come on out here for sure.
Thank you so much, man. Well, you still have a special home in the city, and you come here 2-3 times a week, so it's like you never left. But we'll hang out soon, and thanks for your time, man. I know you're super busy, so appreciate you making time for me and the community to share all the learnings that you've had.
No, this is fun. I love the format, love the questions, Joe. It was a lot of fun, and great to be with you today. Have a great week.
Yeah, you too. Catch up soon.
Bye.
Bye.